Finally, what are some special cases of discounted cash flows? These are some special cases. I can look at cost-cutting proposals. What if I install a new inventory management system and it generates no new sales, but it cuts costs substantially? How do I evaluate that? How do I set the bid price if I'm a road builder, like locally Glen Baker or HRM? Those are two local road construction companies. How do I effectively set that bid price using this discounted cash flow analysis? Same process, income statement first, balance sheet second, statement of cash flows third. And how do I evaluate equipment with different lives? What happens if they have different costs and they last different amounts of time? So let's look at some of these special cases, evaluating cost-cutting proposals. Should we upgrade our facilities or not? Will it help us cut costs? Will we get more cost-effective? Again, same thing, income statement, balance sheet, cash flow. We're considering buying a $200,000 computer-based inventory management system. Sales are zero, but this system will save us $60,000 in cost related to inventory. The relevant tax rate, 39%. At our company, more efficient, we will save $45,000 in net working capital. MPV is 16%. What is the discounted cash flow rate of return? The IRR. So IRR is also called DCF ROI or DCF return on investment. So what is the IRR? Income statement first. Sales are zero with this inventory management system because all it's doing is sitting there and helping us manage inventory. There are no sales generated. The costs are down $60,000 compared to what they were prior. Depreciation is $50,000 per year. That's the $200,000 cost of the equipment depreciated straight line to zero over 4 years. I build my P&L. I calculate my EBIT. I subtract my taxes of negative $3,900, and I get an MPAT of $6,100. Very simple to calculate my OCF. I can just take bottom-up method, which is $6,100 plus $50,000. Or $56,100. That'll come in for 4 years, $56,100 per year. I have a pre-tax gain of after-tax salvage value, $30,000. I can sell the equipment for times 39%. So after tax, I'll get a $11,700 tax payout. I got to pay that out, but that's subtracted from my $30,000 gain. And so after taxes, I'll be bringing in $18,300 after tax salvage value in year 4. I put that in the last year. So for OCFs, I get $56,100, $56,100, $56,100 every year for 4 years. I have to pay out $45,000 of net working capital. Well, I get the improvement, so that's actually positive. That's coming in, $45,000 net working capital positive coming in at time zero when I install the inventory management system, $45,000 of negative when I switch it off and close the system down in year 4, and then $200,000 to buy the equipment today, and there are what our cash flows look like. So my cash flow initially in year 0 is minus $155,000, and then $56,100 for 3 years, and then $29,400 in the 4th year. And once again, I can do all those analyses I did from Chapter 9. I can calculate the MPV. I can calculate the internal rate of return. And we see that MPV is 0 when the discount rate is 11.48%. So that is our IRR, about 11.5%. I can do all those analyses I set up in Chapter number 9 with a series of cash flows. I must submit a competitive bid if I'm a road builder. It's generally who submits the lowest bid, all other things being equal. But the lowest bidder sometimes makes the biggest mistake. So again, we suggest avoiding the winner's curse. Build an income statement, build a balance sheet, build a statement of cash flows, do the MPVs, the IRRs, and the payback periods related to when you're setting the bid price. I'm not sure every construction company does that, but that's what's recommended to avoid that winner's curse when you're bidding on big capital investment jobs. And how about when I have equipment options with different lives? A good example where I used to work at Air Products was on a chemical plant. We want to put a precipitation system to precipitate the bad items out of the air. or we want to filter it using a filtration system to make it just go up the smokestack and go out through the filter so that the NOx and SOx is taken out of the air before it escapes into the environment. To do these equipment analyses with differing lives, we have to do the EAC, equivalent annual cost calculated on an annual basis. So calculate the EAC, still doing the same methods, income statement, balance sheet, and cash flow for both possibilities. And then I want to look at an unknown payment amount, which is the cheapest to buy. So first we have a filtration system option costing $1.1 million to install $60,000 annually before taxes for maintenance to operate. And we'll have to replace it every 5 years. So differing lives, different values, different maintenance costs. The precip system will cost us $1.9 million to install, but only $10,000 to maintain annually, and an operating life of 8 years. So we'll have to replace this one in 8 years. So again, we do the analysis that we need to do on the income statement, the balance sheet, and the cash flow. I'm going to calculate the NPVs for all this. I'm going to calculate the OCFs first, and then the net present value from these. Again, 5 years in the first example, and then 8 years in the second example. And I want to see what is the cheapest to operate on an equivalent annual cost basis. So we see the filtration system OCF is $35,200, and the precip system is $74,150, and this is total OCF. So we need to look at the present value of those costs, discount them back to today at the company's discount rate, and taking into account the capital spending of $1.1 million for the filtration system, $1.9 million for the precip system, and we get a total present value of the cost of about $973,000 for the filtration and $1.5 million for the precip system. And then I have to look at that on an annual basis. So I take that and I calculate that EAC using the total cost, but bringing it back to on an annual basis, on a net present value basis, and I get an EAC of negative almost $270,000 for the filtration system on an annual basis, and $308,000 for the precipitation system. So we see that of the two, we want to take the lower equivalent annual cost, and we'll pick the filtration system. So again, what have I done? I've done a full income statement, a full balance sheet, a full statement of cash flows. I've discounted them back to today, and I've taken into account the different lives of the equipment, and then calculate the equivalent annual cost, and then find the cheaper of the two alternatives. Because these pieces of equipment do wear out, and they do need to be replaced. They are expensive, and they do need to be replaced, so we need to calculate them very, very carefully. So setting a bid price, if I'm the road builder, I want to set the lowest possible price that will result in an NPV of 0. How about if we have unequal economic lives? Well, I need to calculate the EAC. If I have a precip system which has a different life than a filtration system. And how do you interpret the EAC? I look at the present value of the project's cost calculated on an annual basis, and then compare the two annual costs to come up with a good decision. Hope you've enjoyed session 10 of Introduction to Corporate Finance on making major capital investment project decisions.